Well, good evening or good afternoon, everybody. I guess it's not evening yet, although it is getting darker every day. This is your local friendly mortgage guy, Zach P. Smith, here to present the Reverse Mortgage Weekly. It's a weekly webinar that we do every single week. A weekly webinar we do every single week. How about that? Well, I'm here to talk about the reverse mortgage product, and we do this every week at 2 o'clock Mountain Time, 3 o'clock Central Time. I guess that'd be 1 o'clock Pacific, and what is that, 4 o'clock Eastern. So all over the nation, we're broadcasting live and direct, talking about this wonderful program. I'm your host, Zach Smith. I've been in the mortgage and real estate industry for 20 years now. Got in 2003. I graduated from Colorado State University with a restaurant resort management degree. And I went right into the mortgage business. So here I am. Haven't looked back. I own Chariot Financial. We're mortgage brokers, and we do specialize in reverse mortgage. So here we go. This is all about me. So this is a presentation that I put together a few years ago, but I thought I would showcase it here today. One of the reasons that this program has become wildly popular with a lot of older adults is because of some of the statistics coming out with the baby boomer age group. For instance, did you know that 10,000 people are turning 62 every single day? There's fewer pensions and defined benefit plans than there ever has been. In the 70s and the 80s, our politicians worked real hard to make sure that we didn't get pensions anymore. And they said, oh, here's your 401k. This is your gift, our gift to you. Well, 401k is great, but it's not the same as a pension where you're getting guaranteed income every single month. It's more of a, hey, if you plan and you plan well, your 401k will work for you. But most Americans aren't planning, and the ones that aren't they're the ones that are saving aren't saving enough. So this is a huge issue. Lowest return on investments for decades. Although right now with the high interest rates, you're getting pretty good return rate on those CDs. 76% plan to delay retirement. That means that we have folks that are considering to work into their 60s, work into their 70s. We see it. We see it every day. We went out to eat the other day, and I'm not trying to be ageist or anything. I think if you want to work into your 60s and 70s and even your 80s, if you want to work into those years, by all means, I think you should be able to. But most people aren't doing it by choice. Most people are doing it because they're having a hard time making ends meet. Less than 7% of folks have long-term care insurance, but approximately 70% are likely to need it. Now, if you're looking for long-term care insurance, talk to someone who does life insurance. Those are sometimes riders that they can put on their policies, and they can give you all kinds of different stats about how many people are going to need long-term care insurance. Remember, medical bills are still the number one reason why people are filing for bankruptcy here in the United States, in this first world country of prosperity and freedom here that we live in. There's a greater need for security and certainty than ever before, since we're living longer, which creates a lot of concern about running out of money. That's a big concern that a lot of my clients have, is that basically they have a nest egg, but you could live to 70, you could live to 80, you could live to 90, you could live to 100. Well, the difference between 70 and 100 is 30 years. So to plan for that extra 30 years is vital. The biggest concern, again, that a lot of my clients have is running out of funds prematurely. The majority of baby boomers have equity in their homes right now. There was a big study done just a year or two ago that showed that there is trillions of dollars of home equity and right now with baby boomers. And equity is great, but the thing about equity is it's a lot like having a glass coffee table full of cash sitting right there in the middle of your living room. So it's all the cash in there is there. You have it. It's right there in the middle of your living room, but you can't get to it because equity is something that's not liquid. So when you're looking to cash out the equity, basically you either got to sell the property or you have to get a loan taken out, either a reverse mortgage or a normal mortgage. Of course, with the normal mortgage, you're going to have a monthly payment that's required. The reverse mortgage has a monthly payment, but it's not required. If you don't want to make your monthly payment, then you just skip it. that month. And that's the big thing that a lot of people don't focus on, I think, about this program. You have a lot of these financial gurus out there saying, oh, the reverse mortgage, you're going to go upside down your property. It's a bad idea. Keep in mind, if you go upside down on your property, it's really by choice, because you can make a monthly payment, and no one's restricting anybody from making a monthly payment on the reverse mortgage. The key to that is it's optional. 99% of my clients who do a reverse mortgage do it because they don't want to make a monthly payment anymore. And really, you shouldn't be making a monthly payment. If you're over 62, this is my quote, Zach Smith, Chariot Financial. If you're over 62, you should not be making a monthly mortgage payment any longer. And I'll tell you why here in just a few moments here. We're going to go over that. So if all baby boomers retired at 62, 84% would be in jeopardy of running out of money. That's, you line up 10 people, 8 of them are going to be in jeopardy of running out of money prematurely. And another thing that people don't talk about, however, there was an article in Forbes a few years ago that talked about aging parents, and how that is one of the biggest financial risks for middle-aged Americans right now. So mainly because of healthcare costs and things of that nature. At 66, 50% would likely to be running out of money. So again, you line up 10 people, 5 of them, if they retire at 66, are going to be at risk of running out of money. And of course, we have the Center of Retirement Research at Boston College to credit for that, those quotes there. So there's projected changes in population growth from 2019 to 2024. As you can see, 65 to 80 is going to be one of the largest groups. It's going to be basically coming of age here. So right now, the market, look, we've got $712 billion in the credit card industry. That's probably risen a little bit. $1 trillion in auto loans, $1.26 trillion in student loans. And then everything is just dwarfed by the home equity that people have right now. People have equity in their homes. During the COVID days, people were between fighting over toilet paper at the grocery store and, doing things like that. Basically, people were like, you know what? I'm stuck in the house. I'm working from home. I want to move. I want to change my surroundings, do whatever I can. So there was a huge influx of purchase business during that time. And here in Colorado, my gosh, properties just skyrocketed. I remember a client very specifically. They put an offer on a property. They loved it. They said, you know what? We're not going to lose this one. We're going to go in. We're going to make an offer at $60,000 over asking price. I think it's listed for like $700,000. They're going in at $760,000, getting aggressive. We're not going to miss out on that one. Well, guess what? They missed out on that one. They put in an offer $60,000 over asking, and they lost. So the market was just incredibly high. Prices were going up. And another thing that just some tidbits here, just what I see. Now, this is just my opinion. I could be wrong. Sometimes my crystal ball is a little fuzzy. But, the thing is, right now, you got a lot of people waiting to buy real estate. One thing you want to do is you don't want to wait. You don't wait to buy real estate. You buy real estate and then you wait. Because right now, those folks who are waiting, they're waiting for the rates to drop. That's the big thing. The rates are going to drop. Well, I have news for you. Once the rates drop, the prices are going to spring up once again. So it's just, it's better to buy now and then wait. And then when the rates drop, you refinance. But you secured your interest in that property at a lower price. If you wait, you may be paying $50,000, $60,000 more for the same property. I digress. There's a lot of home equity here that seniors have access to. But again, they have it, but it's a lot like having that glass coffee table right there in the middle of your living room that you can't get to. So glass coffee table filled full of cash that you can't get to because it's not liquid. We can't eat our equity. We can't take a picture of it, go down to the grocery store and pay for our groceries with it. So this is a big concept that I want to go over. This is how the reverse mortgage was taught to me by Mr. Harlan Akala. I think he came up with this system, and I'm somewhat of a disciple of his, if you want to call it that. Just an incredibly gifted presenter, and I learned a lot from listening to him. He's out of Wisconsin there. It's where my wife's family's from. So shout out to all the Wisconsin people out there. So these are 3 buckets of finance. So we've got 3 buckets generally that describe our finances. We've got the first bucket here, which is our monthly income. We've got the second bucket, which is our nest egg. And we've got the third bucket here, which is our home equity. Well, during the time when we're employed, basically what we're doing is we're taking income and we're placing it in this bucket, in the bucket number 1. So we're W-2 wages, if we're self-employed, we're making money. And then the other thing we're doing is we're putting money into our nest egg. We're saving in our 401k and our IRAs, stocks, bonds, Roth IRAs, all that stuff. And then at the same time, we're paying off equity or paying off the mortgage that we have on our house. Although, keep in mind with a 30-year note, the deck is really stacked against the consumer. What do I mean by that? So you get a 30-year fixed loan. Well, 50% of the interest on a 30-year fixed loan is being paid in the first 10 years of the note. So what does that mean? So when you're paying your first year, 2, 3 years of the loan, you're paying most of the money, your hard-earned money, whether it's your retirement, your income, your pension, whatever income you have, paying into that mortgage is going mostly towards interest. So just keep that in mind. But we are paying off a small portion of it. The longer we have the note, the more we're paying off into that home equity there. Well, these buckets change drastically in retirement. Mainly, the 2 buckets that really see the biggest change is bucket 1. Well, bucket 1 and bucket 2. So bucket 1 is your monthly income. Well, once you retire, a lot of times we're on fixed incomes. We're on Social Security, we're on pensions, we're working part-time, we're volunteering, whatever. Of course, we don't get paid to volunteer, but we're living off of our limited income in most cases. The bucket number 2 becomes vitally important. Now, the reason that bucket becomes so important is because, again, we don't know how long we're going to need our nest egg. That's one of the biggest concerns that a lot of my clients have, is running out of money prematurely. And it is a very vital concern. Most of the time what happens is, and again, our equity doesn't do any good for us in retirement because it's not liquid. We can't access it. It's that glass coffee table full of cash that we can't get to. So what happens most of the time is that people will exhaust their entire retirement funds, and then they're living in a house, it's paid off, they have all this equity in it. Well, what do they end up doing? They end up selling the house and living off of that, moving in with family or whatever the case is. And there's nothing wrong with that setup. There's nothing wrong with exhausting your entire life savings and then moving in with family and stuff like that. But it's really not the desirable way that most people want to handle their retirement. And in my opinion, I don't think it's the wisest way, because a lot of people do want to age in place. They want to age in their home. And in some cases, it's just not possible. In those cases, you can downsize using a reverse mortgage or, whatever the case is. But that becomes a big issue. Now, the reverse mortgage is designed so that people will be able to stay in their homes and keep their nest egg solvent. This is the example that I was getting back to. Again, if you're 62 or over, you should not be making a mortgage payment, because if you are, you're taking it from bucket 1, which is your limited income. So your cash flow goes down. I run into this all the time with my clients, that people are looking for more cash flow. They're just not making the same amount that they did. They don't have a big pension coming in or anything like that. And they need cash flow. And, or if you are making a monthly mortgage payment, you're either taking it from bucket number 1, which is a limited cash flow, or you're taking it from bucket number 2. Now that's the bucket that you want to keep solvent. That's the bucket that is kind of your crown jewel when you go into retirement. And if it were up to me, none of my clients would ever have to touch that bucket number 2. They would be able to live sufficiently on either their fixed incomes and the equity that they have in their homes. That's the idea of the reverse mortgage. It's not to pass on more equity, it's to pass on a higher net worth. So, again, where the reverse mortgage can help out with that, I'll give you an example. So, the big thing to remember about the reverse mortgage, and I touched on this earlier in our presentation, is that the payments are optional. Yes, there's a monthly payment, just like any other mortgage. If you want to make a monthly payment every month and do a reverse mortgage, go for it. There's nobody stopping you from doing that. It's absolutely fine. However, if you do, most of my clients choose not to do that. So for instance, we've had clients in the past that would be taking money out of their life savings every single month. I had a gal, just a few years ago. She had lost her husband 2 years prior. He was kind of the guy who paid for all the bills, and so when he left, there was a big emptiness there, but she wanted to stay in her home. But she had about a $1,500 mortgage payment that was just the principal and interest portion. One note about the reverse mortgage product is that you do have to pay your taxes and insurance separately. So just keep that in mind. There's stories out there about people, this person, got in trouble and, they almost lost their house because they had a reverse mortgage. Then you ask them, well, what happened? Well, they didn't pay their taxes. Well, that's not a reverse mortgage thing. If you have a reverse mortgage, a forward mortgage, no mortgage, if you don't pay your taxes, you're going to get in trouble. So again, keep in mind to read into the details about what people are talking about this program. What is fact and what is fiction is something to pay very close attention to. But she was taking money out of her life savings, out of bucket number 2, every single month so that she could pay her mortgage payment. Now, again, she's taking money out of her life savings so that she could pay her mortgage payment each month. So she was running in the red every single month. And that bucket number 2 was dwindling each month. Well, I'll tell you, she didn't have that much in savings. She only had about $14,000, and she was supplementing, I think, $500 a month. That is a recipe for disaster, because at some point, something's got to give. And usually what happens in these situations is people will run out of their savings, and then they start going red. And then if you're in a forward mortgage, you can get in trouble, because if you go 3 months delinquent on a forward mortgage, well, then they're going to start the foreclosure proceedings, or they can start it. Not that they will, but they can. And then 3 months after that, they can sell your house off in auction. At least that's how it works here in Colorado. So the safest loan program to be in, if you are running low on cash, is a reverse mortgage, because there's no required monthly payment. So that's exactly what we did for this client. So instead of her paying that $1,500 each month, and again, keep in mind, on a 30-year fixed loan, most of that money you're paying on that $1,500 is going right to the bank. It's going right to interest. So basically what we did was we converted her loan into a payment optional reverse mortgage. So now that $1,500 that she was sending to the bank so that she could fill their coffers with the interest money, see, that $1,500, guess where that was going? It was going right back into her pocket. And now she has the ability to take that $1,500 and direct it. She can do whatever she wants to do with it. She's not locking it up into her equity, because once it goes into your equity, the only way to get it back out is to sell the house or to refinance it. So by changing her loan, and we're also able to establish a line of credit behind that. So now not only does she have an extra $1,500 in her pocket, she also has a line of credit behind that she can borrow off of if she needs to. And that's key. That is key, because if you take money out of your line of credit that you have with your reverse mortgage, you're not taking it out of bucket 2. Bucket 2, again, is the bucket that we need to keep solvent for as long as possible because we don't know how long we're going to need it. And there's a fear of running out of cash prematurely. It's a real fear. So now instead of money going out of bucket two to pay interest on her mortgage, well, guess where it's going now? It's going back into bucket two. So now she gets her fixed income. She doesn't have that $1,500 bill anymore. So now she's putting an extra $500. Instead of $500 coming out of her savings, $500 is going back into her savings. So this was really a life-changing event for her overnight. Now, there's a lot of different opinions out there about the reverse mortgage by, again, I'll mention these financial gurus. I don't want to mention anybody by name, but I do want to mention people. I will refrain, though. I'm a professional, by golly. And so I will refrain mentioning any of these financial gurus by name. But a lot of them have a negative connotation of this program because they feel like the negative amortization. The other thing they don't like about this program is that there's an upfront mortgage insurance premium. So it's an expensive loan upfront. And they look at those costs and they say, oh gosh, it's a bad idea. You're going to go upside down in your house. Bank's going to own your house, and you're paying a lot of fees upfront. A lot of those things aren't even close to being true. One, you still own the property. So it's still a property that's in your name. It's just like any other loan. If you sell it, your heirs are going to get the remaining proceeds. Number two, yes, you can go negatively amortizing on this program. Again, that is a choice. If you want to make a monthly payment, you can, but this gives you the option. You don't want to make a monthly payment this month? Go ahead, skip the payment, and it'll just go back onto the mortgage. So you can still make a monthly payment. You're just not forced to like you would be on a forward mortgage. And most people, they're forced to make that monthly payment. And again, the problem I have with a lot of this is the amortization schedule. That's why I'm a big proponent of the first lien HELOCs, where you can do all of your banking and combine your mortgage all into one simple interest. You pay off your loan much, much faster with a simple interest mortgage because you're not locked into an amortization schedule. I'll say it here first. I think amortization schedules are for suckers, and most Americans are being put in this position where they're locked into a program and say, okay, we'll get you, a loan, but we're going to charge you 50% of the interest in the first third of the loan. So it's a bad deal for the consumer, but most of us consumers don't know. And, and honestly, there's not a whole lot of other options out there. It's kind of like Mark Twain, everybody complains about the weather, but nobody does anything about it. So that's just one example of how these programs can save people's financial situation. And what I'm going back to with these financial gurus is they all have an opinion on it. But if you really want to know how this program is working out for somebody, if you really want to get down to brass tacks and find out what it's doing for folks, talk to somebody who has one. Talk to somebody who has a reverse mortgage and see how it's working out for them. Because this program, there's literally been people just weeping at closing, because this program has changed their lives overnight. And one of the important things to remember is that, the risk assessment on a reverse mortgage is completely different than it is on a forward mortgage. I've had clients come to me that, would go all over town. This lady was trying to downsize on her property. She wanted to sell her home, and she wanted to move into use those proceeds and use those to buy a house in a active adult community next to her friends. All of her friends were there. And, I love the active adult communities because you're not just buying a house, you are buying a community. And for those of you who don't know what those are, it's for communities that are 55 plus. So basically you have to be a certain age to live in these type of communities. And she desperately wanted to live. An apartment came up. She was going all over town trying to get a mortgage. And everybody was saying, you know what? Sorry, Charlie, you don't qualify. You don't make enough. Your credit's not good. Go somewhere else. And so she went all over town. Everybody told her no. until her agent that she was working with. I teach classes for the state of Colorado for continuing education credits for real estate agents, and her agent had taken one of my classes about the reverse mortgage, and she said, "Well, hey, why don't you give this person a call?" So I met with her, and I was a little skeptical. Not gonna sugarcoat it one bit. I was a little bit skeptical because a lot of times, if I'm meeting with people and they have a situation where they have been told no all over town, I'm thinking to myself, okay, where there's smoke, there's fire. So what's going on? So sure enough, I pulled her credit. Her credit was pretty subpar. I mean, it was low. I mean, it's in the low 500s. She had some issues prior, and a lot of these issues stemmed to her not having a lot of cash flow. So that really became an issue. Well, she did have equity in her house, and I did when I pulled her credit. I saw a long list of lenders. Everybody was looking at her credit. She'd been told no, and she was really in just distraught when I met with her. But I asked her, I said, has anybody ever talked to you about purchasing the house as a reverse mortgage? And she was surprised. No. And, I was looking at some of the lenders that were pulling her credit on the inquiries on her credit report. And I'm thinking to myself, well, gosh, this bank, they do reverse mortgages too. I know these folks are down the street. No one had talked to her about purchasing the house as a reverse mortgage. Now, the risk assessment for the reverse mortgage is completely different than on a forward mortgage. On a forward mortgage, they'll say, okay, we'll lend you this money. We'll lend you $200,000 to buy a house. First question they have is, how are you going to pay us back? So what do they look at? They look at your income. They look at your assets. They look at your credit. And then they look at all those factors and they say, okay, you're a good credit risk. We'll lend you the money so that you can pay us that 50% of the interest in the first 10 years of that 30-year fix. You've qualified for our wonderful amortized program that we have for you. I laugh, but it's, that's just the way where the banks have set things up for the average consumer. So basically, the risk assessment with the reverse mortgage is based on two things. It's based on your equity, and it's based on your age. It's not so much based on your income. Now, you still have to look at the income. You still have to look at the credit, but that's really to determine if we have to set up a life expectancy set aside, which is a real fancy name for an escrow account. So when I looked at her situation, she was a great candidate for the reverse mortgage purchase program. So what we did is we got things set up for her. She listed her house. She sold it. We got her pre-approved, got her into the apartment right next to her friend in the active adult community. And she went from a client that was completely distraught. It's hard to hear rejection over and over and over again. I I know all about it. So it's hard, and it starts to wear you down. So she went from someone who was just like, okay, this is the last, we'll give this a shot, probably thinking that I couldn't do anything either. And when I first started working with her, I kind of thought the same thing. Gosh, if everybody's declined her all over town, what am I going to do? How am I different? But people just never had the foresight or the foresight to really look into this program as a purchase for her. So what ended up happening was, she sold her house. She used those proceeds to put down on the new property. She didn't have enough when she sold the house to buy it cash, which is the reason why she needed a reverse mortgage. So we came in with a portion that she couldn't come down with her sale of her residence. And now she lives in a property that she loves. And for the rest of her life, she does not have to worry about making a mortgage payment. Isn't that incredible? So she went from someone who is distraught to someone who is basically in the perfect situation for her. Housing for most of us is our largest expense. If you don't believe me, ask some of these young folks who are out there paying incredible amounts for rent right now. I mean, rent is just crazy. The big thing that everybody's into right now is house hacking. You buy a house and then you rent out each room on an individual lease. Well, the reason people are really into that is because it's lucrative right now because the rents are so high. So the house hacking is basically you rent a room. It's not an ideal living situation for anybody, really, especially if you don't get along with the folks who you're living in the same domicile with. But people are resorting to that because they don't have any other choice. The rents are way too high for the income right now. So if you have any questions for me, you can always reach me at chariotreverse.com. I come on here every single Wednesday, 2 o'clock Central, or I'm sorry, 2 o'clock Mountain Time, 3 o'clock Central Time. That's 1 o'clock Pacific Time, 4 o'clock Eastern Time. You can reach me any time of the day, 24 hours a day. I'm a robot. I don't sleep. ChariotReverse.com. Once again, you can visit us at chariotreverse.com. That's chariotreverse.com. If there's anything we can do for you, don't hesitate to give us a call. And I hope you all have a blessed day. Thank you so much for hanging out with me today. And we'll see you next time. Thanks a lot.